Hey everyone, welcome to Fellowship of the Frugal. My name is Daniel. In today's video we're going to talk about the prime rate. I'm going to tell you exactly what it is and how to understand it and what goes behind it and how it's formed and all those things. I'm going to show you a little bit of history of it. And so by the end of this video, hopefully it makes a lot more sense and you'll understand why it's been in the news so much lately. So instead of thinking, what in the world does this mean? You should know exactly what's going on and exactly what it means. So if you like this video, be sure to subscribe, add some comments and some feedback, and I'll continue to get videos like this out so it can hopefully help you on your financial journey. Hope you enjoy. Alright, so what exactly is the prime rate? Well, simply put, the prime rate is the rate that banks charge their best customers. So this is something that the banks determine, not the Federal Reserve. So if there's some confusion about that, I'll help to clarify. Now, whenever you hear about the Federal Reserve changing a rate or setting a new rate or increasing the rate, whenever you hear anything like that, what we're talking about is the Federal Open Market Committee, or the FOMC, also called the Federal Reserve Board. When they have a meeting and then they increase or decrease the rate, what they're actually increasing or decreasing is the Fed funds rate. Now the Fed funds rate is how much that banks charge each other to borrow money from each other. So to take it a step back even further, banks have a reserve requirement, or at least they've traditionally had a reserve requirement. In March 26th of 2020, that was removed as a result of COVID. The reserve requirement has typically been 10%, meaning if a bank has $100 million on deposits, and they have to keep 10 million of that, and then they can turn around and loan out the other 90 million to try to make some money on it. That's the primary way the banks make money. You put your deposits with them, they turn around and lend 90% of it out and charge interest on it, and then that interest is paid directly to the bank along with fees and maybe a few other things. But what can happen is if a bank is borderline on that requirement and then some big loans come through that they need to fund but don't have the cash reserves available to do it, at least not according to the rules, they can borrow money from another institution to try to meet that requirement. So then that way the loan can be approved and the money can be given to the applicant as a loan. Meanwhile, the bank makes their requirement, but then the bank that they borrowed the money from is charging them an interest rate. That interest rate is typically going to be the Fed funds rate. Now the bank, since the prime rate is charged by banks to their best customers, the bank can then charge that prime rate or whatever rate they determine for that customer who actually borrowed the money. So when the Fed meets, which is typically 8 times a year, and they change rates, are they actually changing the prime rate? Well, really no, what they're changing is the Fed funds rate. However, the prime rate is going to go up in step with the Fed funds rate. So if the Fed increases the rate by 0.5%, the prime rate's pretty much going to go up by 0.5% every time. And so in a way, no, the Fed is not actually the one changing the prime rate, but really they are in practice, because it directly affects what the banks are then going to do with their rate. And so what most banks will use is the Wall Street Journal prime rate. They'll just get whatever, or use whatever number that they say, whatever percentage rate. So like today, for example, the prime rate is 8.25 as of this video, meaning the best customers, depending on the type of loan, if they're given money at a rate of prime for interest, that's the best rate that the bank is going to offer. Now you may notice on your loans, if you have a variable loan of some kind, like either a home equity line of credit or on a credit card, you may see your rate as a formula. It may say something like prime plus 1 or P plus 1. What it's saying is it's tied directly to what the prime rate is at any given time. So if the prime rate increases, then the rate on that loan is going to increase as well. Same with the decrease. It'll go right in step with whatever banks set the prime rate at that given time. So there's a lot of confusion about the Fed funds rate versus the prime rate. So I'm here to tell you the banks set the prime rate, the Federal Reserve sets the Fed funds rate, but they are basically linked to where they're going to be in step with one another. As far as the history of this, I posted a few links that'll be helpful to you. This attachment here shows the Fed funds rate as of the last maybe a little over a year. You see the activity that has taken place. It's been increasing pretty dramatically, and you see over here on the right what the end result rate is. In the middle just tells you how much it was increased per meeting by basis points. So like 75 basis points is the same as 0.75%. And then if you look more recently past that, you see the rate decreases with COVID in 2020. You see some cuts in 2019 that are listed here. And then around the 2015 to 2018 time frame, you see a number of increases that took place, all 0.25% or 25 basis points. But more recently, before COVID, the biggest one was probably going to be the Great Recession, where you see 2007, 2008, the rate kept going down right here, and that was to try to increase the money supply to get more people some available funds to use. Now, I'm not going to go into depth on explaining that part of it, but I'm just going to tell you that that's what the Fed rate has done over the years. And then this link shows you what the prime rate has done. Now you see this is the most recent one as of this video that was set on May the 4th at 8.25%, and you see it steadily climbing over the last year. So even a year ago it was at 4%, and so it's increased 4.25% in the last year, which in the lending world, that's a big difference. And so it affects how much people pay in interest when they borrow money from the bank. Some people may still need to borrow the money, and they have no choice but to borrow at a higher interest rate. And sometimes we can get kind of spoiled if the rate is lower, like it was when it was around 3.5% or so for a while. And then if it starts to shoot up, people can definitely get upset because they're paying more interest for the same money. But this is the way that it looks over time. These links will help you to look at it on your own time, just to get a better idea of just historically, more recently, what it's been doing. So that's the reason you've been seeing it in the news so much lately, is because the Fed meets and then they do increase rates. At least they have been over the last year or so. They've increased pretty much every time they've met, 0.25% or somewhere around there, 0.5% every given time. And so ultimately the reason for doing that is they're trying to curb inflation and trying to decrease the money supply so that the inflation rate won't be skyrocketed like it has been. I mean, you probably heard it's been in the 8 to 9% year over year lately, which to me is a low estimate, but it has been out of control. So that's the reason why they meet an increased rate, is to trying to curb inflation is the whole reason for that. So with that being said, I hope this clarifies the difference between the two. And if on your own free time, you can look at some of these articles and see what's what. It may make a little more sense to you. But if this video helps, be sure to let me know, and I'll be sure to get out some more videos in the future. So check out the other ones, and I hope to see you again soon.